Gotcha. Thank you. So this is very interesting. So let's begin with the questionings for 5 minutes. Mr. Pollack, you use the expression in your written testimony about double leveraging of the GSEs by the banking industry sector system. Could you give me just briefly, about a minute or so, less, a little more detail on this and discuss what steps you sort of touched on how we do to curtail that double leveraging?
Yes, thank you, Mr. Chairman. As I mentioned, the interaction between the way that lending money and investing in the GSEs was encouraged by regulation in the banking system, and the GSEs themselves resulted in double leverage or hyper leverage. One example is with preferred stock. A large amount of the capital of the GSEs was in the form of preferred stock. That preferred stock could get leveraged 60 to 1, 60 in debt to 1 in stock by the GSEs. But among the biggest buyers of the preferred stock and encouraged by regulation were commercial banks, and the banks themselves owned that stock on a leveraged basis or a margin basis with a risk-based capital requirement of only 20% risk weighting, which is equivalent to 1.6% capital. In other words, they own the equity of the GSEs on a 98% margin basis, like buying stock on 98% margin. So if you combine the banking system with the GSEs and think about that as a total system, there was virtually no real equity, and you had a leverage of 60 squared or over 3,000 to 1. And that thinking about that interaction between the banks and the GSEs is, I think, critical. I'll just mention quickly, if I may, also banks were encouraged to hold GSE debt and mortgage-backed securities without limit, so that you got over-concentration in GSE risk by the banks.
Thank you. And just running down, Ms. Bartel, right now we're trying to take actions. What can we do today? We're looking at the GSEs today. They're in conservatorship, lots of money going out the door. A couple things that are going to be coming up. The FA is soon to announce that executive compensation is going to be to their executives at Fannie and Freddie. What's your position on the exec compensation packages that we've seen over there? Quite high compensation. Should the taxpayer basically be funding these quite high compensation packages in your view?
Well, I think what is important for the GSEs is that because they do represent a significant contingent liability, potential liability for the taxpayers, it's very important that they be able to continue to attract the talent to manage their obligations. And I do, in their current situation, believe that it is difficult for them. They're seeing a great deal of runoff already of their senior leadership into private institutions, and the ability to attract people, for example, to manage servicing and manage and retain assets. So I don't have a position particularly on the current compensation packages. I understand the difficulty that they present, but I also think it's really important that we don't let them lose talent to manage and protect the taxpayer's ultimate outcome.
I guess you just have to be careful with that, because over Ginnie Mae and FHA, they're sort of having to deal with the same problems over there, and they're not getting the same compensation package. So we may be getting a call for raising their giving them bonuses if we're not willing to do it here. Let me just ask you one other question. With them in conservatorship right now, is now a good time to address the issue or have them issuing affordable housing goals? Do you think that should be something they should be doing right now?
I think what's important, and what we would suggest for both the near term and the long term, is that the secondary market serve what the private market, the primary market is doing.
How about just the near term? Because I'm looking at what we could do for them.
Right. Well, in the near term, the affordable housing goals is written in the statute that the conservator is now still implementing, required the GSEs to lead the market. The rulemaking by the Bush administration that really forced them to stretch out ahead of the market is where I think the goals really got out of bounds. Requiring the secondary market to continue to serve the primary market, the loans that lenders are making, and not cherry pick those loans so that we end up with communities without access to capital, communities that are effectively credit deserts, seems to me an important ongoing obligation. We just don't want to make them stretch in ways that have them make unsafe loans.
Okay. And in my 30 seconds time, because I'm going to try to keep the time here, Mr. Randazzo, Ms. Calabria, you both discussed variations of how to treat their outstanding debt. Mr. Randazzo, could you expound on your idea to bring that debt online with the Treasury and the Treasury's balance sheet and the potential taxpayers' savings there? And have you had any discussion, I should say, also with Treasury on this as well?
You're speaking specifically to how to bring the debt of the GSEs in
Right,
line.
and onto the Treasury's balance sheet, and then the tax savings that results here. And you
Well,
do that in 15 seconds.
Sure. Well, in short, the GSEs, because they are not technically government agencies right now, pay more to issue debt than the Treasury Department does. And by bringing those portfolios onto the Treasury's debt, you would have roughly 25 basis points cheaper borrowing when you reissue short-term debt. And given that over the next year, about 40% of their debt is going to come up for renewal, that has potential savings of anywhere between $4 and $12 billion for taxpayers just by having those portfolios run off on the Treasury's balance sheet as opposed to in a separate holding company.
And my time has expired. Ms. Waters for 5 minutes.
Thank you very much.